Welcome back. We'll take a closer look at the day's market action now with Yatheen Singh from Momentum Securities. Thank you so much for your time, Yatheen. Pretty, I guess, encouraging day since we did end off slightly in the green on the JSE. But what was really interesting is the commodity rally that we saw, and particularly on the coal and iron ore miners. Thungela up by about 9% today. What's given those miners a spring in their step?
Yes, quite aptly put, Zanati. So we did see diversified miners and PGMs close at really sort of buoyant levels, with Exxaro even finishing up 7.2% there. And to a large extent, this has been driven by renewed tariff-related market momentum. So the rally followed the Trump administration's imposition of a fresh 50% tariff placed on the Brazilian economy, thereby sparking broader commodity market-based reactions. There have been a fair degree of speculations that this comes with regards to Trump's disagreement with regards to the treatment of the former president of Brazil, Jair Bolsonaro. He has actually been Trump's long-seen sort of ticket out of that economy, and also to a large extent his peer. In terms of what this rally and momentum actually speaks to, it's actually coming at a fairly opportune time, because copper-related tariffs aside, we are also seeing fairly strong demand within auto catalyst demand, higher vehicle loadings, and obviously larger inventory destocking cycle that has emerged as cyclical tailwinds for PGMs as well. So this, to a large extent, has been driven by a plethora of structural and now both cyclical factors. So now that we're seeing more pricing support coming through for these diversified miners and PGMs, these factors does suggest an overall broader improvement in sentiment and potential upside within diversified miners going forward.
Indeed, yeah. Quite interesting to see that turnaround in the cycle there. And of course, we'll see how it goes in the next few weeks. Well, as we're talking about U.S. affairs, the Fed came out with its minutes last night. I guess there is a narrative that there are cuts to come, but of course, not really sure how many are to come because of the risk of tariffs. What tone did you get from those minutes?
So, in our opinion, the path of potential, or rather for potential easing within the Fed funds rates, can be so fairly predicated on the following basis, right? Number one, firstly, to a large extent, I think that it is going to be influenced by the degree of quantitative easing that we see within the economy. And that is quite necessary now, particularly at a time in the economy where stimulus is needed to offset fiscal pressures from increased issuance, or rather through the increased issuance of longer-dated treasuries. Now, what this could lead to is longer-term dollar weakness, especially as fiscal imbalances grow. And the U.S. fiscal deficit, it's also important to note that that's projected to come in just under 6.2% of GDP. That's near 50-year highs. So I think that a material reduction in government spending is needed to support a more sustainable disinflation path. Just tying into my previous comment on the diversifieds, I mean, to a large extent, China has been that growth engine. And to a large extent within the U.S. economy, a lot of the disinflation that we have seen has been placed, or rather passed on, from China. So if one has to go through the minutes, I know they have taken a fairly cautious approach going forward. But what is more important, or rather significant to monitor, will actually be the inflationary trajectory at a headline level. So if one has to look at shelter inflation, that does remain a key concern given its significant weighting in the overall inflation index. And obviously the U.S. debt ceiling, which has now been reinstated at $36 trillion. That just highlights the scale of the fiscal challenges that presents itself to the U.S. economy going forward. But I think markets are currently pricing in the chances of at least 50 basis points worth of cuts before the end of the year.
All right. Well, I want to know what investors are pricing in when it comes to Telkom, because I saw that shares surging about 6% today. I don't know if it was the SENS announcement that came out that the PIC has scooped out more shares in the telecoms company. What do you make of how Telkom is performing these days?
Yeah, it appears that it's a good time to be positioned within these defensive stocks. Telecoms, or rather telcos as a sector, they do have fairly defensive traits in terms of how their books and their portfolios are positioned. So if one has to look at Telkom, And some of the key takeaways that I got from their FY25 result is just that we are seeing a stronger than expected rebound in sort of cash flows and returns back to a more sustainable dividend payout path. So we did see the conclusion of the SwiftNet deal, and that obviously provided some strength to their balance sheet. And however, what it does is it counteracts this sort of earnings tailwind, which is positive, with some possibility of earnings dilution. Okay. So I would say that the earnings growth outlook is going to be fairly underpinned, and this is particular to Telkom, by its mobile recovery, its ITC recovery, and obviously a reduced legacy drag coming from the towers. And despite, or rather more excessive inflationary price hikes being priced in at this current point in time, this does pressure the mobile money market share, in terms of what's shared or rather currently shared between Vodacom, MTN, and Telkom. Because Vodacom, or rather unlike Telkom, which is a pure SA-centric play, Vodacom and MTN does have more diversified books in terms of its offshore exposure. However, they haven't had the best of track records and only seeing a fair degree of improvement in those equity positions now. A vector that Telkom has improved on. Okay. So I am not surprised at all to see this re-rating in the share price.
All right. Well, let us go to your stock pick for today. Where are you seeing opportunity, Yatheen?
So in light of, South African long bond yields trudging lower and earnings growth remaining fairly broadly positive within the SA banking space and within the SA rate-sensitive space as a general, because if you look at the earnings yield of rate-sensitive SA stocks, these tend to follow bond yields to a fairly strong correlation and degree. So my stock for the day is actually Absa Group. And if I can just chat quickly to the key themes in the banking sector. So we're currently seeing easing in credit loss ratios within the cycle. And obviously, this is Absa, Nedbank, Standard Bank, and FirstRand ex Capitec. The credit loss ratios there are currently at through the cycle targets. So that's fairly positive. We're seeing a very sustainable pace of deliberate moderation within those credit loss ratios. We are seeing non-interest revenue growth continue to show its resilience, mostly on the back of improvement in asset quality. We're also seeing net interest income coming under slightly less pressure, and to a large extent that actually speaks to our investment case on Absa because of their structural hedge, which I'll touch on just now. We've also seen slower loan growth and more competitive pricing within the environment because obviously there's a material lack of new investment money flow within our market at current times. It's more cannibalization. And if one is to look at Absa specifically, year to date, they have benefited from a 33.9% appreciation in the Ghanaian cedi against the ZAR. And we know that Ghana, contributes approximately 7% towards Absa's group profit. So that makes the currency gain materially more impactful. The group also has a structural hedge in place, and this does offer a fair degree of protection against easing interest rates. So if it is our view, if we are to see a GDP growth shoot past that that downwardly revised 0.7% target, which would obviously warrant a more aggressive pace of interest rate cuts locally, we would see Absa on book and academically actually gain to benefit over its peers from that perspective. And, it's currently trading at a forward PE of about 5.8 times. So it does suggest a potential more material valuation upside and a more premium valuation tag than what it's currently trading on.
All right. Well, thank you so much for your time and for your insights on what has been moving in investors' money today. I think really appreciated. That was Yatheen Singh from Momentum Securities.